Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. Dirk, you tell us that positive surprises leading negative here now that earnings season is finally underway for the third quarter. My question is, with everything else going on, who's actually paying attention to corporate profits?
Well, I think people are going to be paying attention to corporate profits, kind of wondering, just how bad it's going to get. Because, after, the storm of the immediate credit crunch is over, it really is time to go out and survey the damage and gawk at the flooding and stuff like that. And the damage to corporate earnings kind of is that flooding.
All right, so we're having a gaper's kind of delay here if you compared to the traffic situation.
Yeah, and also, we're still early, at least when we ran these numbers, only 34 companies had reported, and expectations were set, fairly low, but they're coming down with a vengeance. And a 3-2 margin is about half of what we normally see. So, given the propensity for companies to, under-promise and over-deliver, well, they've been under-promising but not really over-delivering.
So you tell us that, not surprisingly, financials expected to post the worst performance of the quarter. Okay, no news there. I think the real story lies in the fact that with a recession still kind of out in the wings, there might be some concern about tech earnings, maybe more than normal, because everybody's looking for tech to pull us out of any recession that might manifest itself.
Yeah, well, tech is really the new capital goods. And in a recession, companies start paring back their spending and say, will this PC last for 3 years instead of 2 years, or 4 years instead of 3 years?
Right.
Can we make do with what we have? Also, a big part of tech is consumer electronics, which is, at the heart of it, really a discretionary item. Do you really need that 42-inch flat panel TV?
Right.
You need to get something digital where you're just going to be looking at a black screen. But
so you've just underscored for me. So are you concerned about tech?
I'm concerned about virtually everything in terms of earnings. It's just plain ugly. The expectations are way too high, I think, across the board. And we're seeing that in the estimate cuts across the board. Almost 5-to-1 cuts over increases for this year and or for next year, and 4-to-1 for this year. That is, an extraordinary ratio, and we track a 4-week moving total.
Right.
I'm pretty convinced that all the increases were, 3 and 4 weeks ago and are going to be dropping off. There has been enormous damage already done to the real economy. Fortunately, while we have a severe recession baked into the cake, finally, over the weekend, the finance ministers of the world decided to turn the oven off.
Right.
So we're no longer looking at a probable scenario of an economic outlook that looks like the early 30s. We are, however, looking at an economic outlook that looks as bad as the early 80s.
Another thing we're looking at is several companies already sounding the caution bell about their profit prospects for 3Qs. So what about the earnings for companies in the sectors that don't have government support?
Oh, yeah, again, that's the real economy that I was talking about, Main Street versus Wall Street, if you will. When you have companies that don't have any access to credit, the commercial paper market shut down, the banks refusing to extend lines of credit. Classic example in my mind is the retailers. Christmas is coming up. You got to stock the shelves.
Right.
You can't stock the shelves. It's going to be a pretty lousy Christmas, and it is anyways, because consumers don't have access to the housing ATM anymore, have not been saving for a long time. Incomes are going down as you have more layoffs, and very few people are getting raises or bonuses this year. So consumers have to pull in their belt. Where is that going to be felt? It's going to be felt in the retailers, particularly the sort of the mid-price retailers. some things people just have to shop for, but they'll end up going to Walmart and Costco instead of JCPenney.
All right. So best expected results you outlined for us are still in energy, technology, industrials, and telecom, correct?
Yeah, I mean, energy energy followed by consumer staples. Particularly, I think the total net income figures are far more important than the median EPS numbers this time around, and the median EPS numbers look a little bit anomalous. So it's energy, and then you drop way down to consumer staples. Consumer staples just doesn't change that much with the economic environment. And after that, nobody has any earnings growth whatsoever. The next highest is 1%.
So safe to say that corporate profits are on the verge of falling for a fifth straight quarter.
Lead pipe cinch.
Okay. Very quickly, what is that famous revisions ratio telling you at this point in time?
Well, that was what I was talking about, where for this year it's running 4-to-1 against and 5-to-1 for next year, and in all probability is going to get worse.
All right. Earnings Trends provides investors with an in-depth analysis of the markets along with the profit performance of S&P 500 companies. And each week this report identifies which S&P 500 sectors are showing strength and which are showing weakness. In addition, the report highlights the most attractive sectors based on valuation and projected earnings growth. I would encourage you to read Dirk's entire commentary, the text version for this current week, including viewing his median growth and revisions tables, and you can do all of that right online. When you go to Zacks.com, you scroll down to the bottom of the page, and you link to it right off of our homepage. With Dirk Van Dyke, I'm Terry Ruffalo.